Together with Charlie Munger, Warren Buffett began their conversation by stating that the rate at which the world is changing is quite rapid. You are aware that the banking industry as a whole has earned rates that far exceed those of intangible equity. He contemplates the amount of money that other more illustrious businesses have made in recent years. Well, he means basically that banking is a good business if you don't do stupid things on the asset side. And it's a business that the banks we control earn amongst the commercial banks. So there you have it. Banking is a good business. They make anything from 12 to 16% on the side hustle that have nothing to do with actual assets. That's a smart way to run a firm. It is a great way to make a living. If you have an option between an instrument yielding 2% and one yielding 12%, you will know at 2% which instrument will be better long-term investment. This is because the long-term bond yields 2%. If you were to ask him whether he thinks banks are going to go down to where they only earn 3 or 4% on tangible assets, he would say that he does not believe that this would happen. The interviewer wanted to know what Warren Buffett thought about the comparison of the PE multiples of bank equities to those of the S&P 500. They appear to be trading at levels that are 35 to 50 years below the S&P 500. In addition to this, he was curious as to whether or not this was the outcome of a shift in the market's judgment of the forward growth rates of banks, or whether or not the market believed that there was a change in risk there. The relative multiple of bank stocks in comparison to the S&P back in the 1940s, 1950s, and 1960s was typically traded at one time in terms of the SP multiple. However, today they are maybe worth only half of that multiple. They are not something that Warren Buffett seriously considers. What he means is that determining the right multiple for a company in relation to the S&P will depend on what you expect that company to achieve in terms of returns on equity and incremental returns on incremental equity in comparison to the S&P. This is what he means. If you have two different kinds of businesses that are on the verge of going out of business, and let's say the SP earns on equity and can deploy an additional amount of capital at variable, then you compare that to any other business, and based on the results, you can determine which one is the more cost-effective option. Warren Buffett has been quoted as saying that he does not consider all banks to be equivalent. He is referring to John, for instance, who is present in the room with them at the time of the forum. John is the one who heads the Bank of Granite in North Carolina, and under his leadership, the bank has consistently made 2% on assets for decades without taking any significant risks. And it's a fantastic record all around. And then there are other financial institutions that have been managed by individuals who have brought them to their knees. They have a few stocks in a few different financial institutions. We are owners of the stock, which is currently being displayed in the basement. They are shareholders in Wells Fargo and Company. In addition, they consider those establishments to be rather unique in comparison to other firms. People are always looking for a recipe. They approach the clever investor with the assumption that he would provide them with a simple formula that, after they punch in the relevant information, will result in a significant increase in their financial well-being. And it is no way how the system is designed to function at all. You are going to take into consideration all of the cash that a company will produce between now and the day of judgment. Then you are going to discount that cash back at a rate that is reasonable. And then you are going to attempt to buy it for a price that is significantly lower than that. The effect on the economy of spending the same amount of money by a brick-and-mortar bank, an online company, or a brick corporation has the same effect. This is due to the fact that all three categories of companies make the same kinds of financial decisions. Now is the time to find a solution to the following question. What are the economic qualities of the internet company, the bank, or the brick industry that tell you how much cash they are going to generate over lengthy periods of time in the future? As a result, it is highly improbable that he will have the desire to acquire a one-yard sticker in connection with the PE that was successful. According to him, the prices at which the banks have marketed their products and services are quite fair. 1969 was the year that they completed this acquisition of each and every financial institution. They obtained ownership of a banking institution located in the Rockford region of Illinois. They laboriously made their way across the terrain, and as they did so, they came across a few unusual banks that they found appealing along the road. They were also distinguished by an exceptionally low level of risk on the asset side, and extremely low interest rates for money deposited. Even Charlie Munger and Warren Buffett can comprehend it. not to mention the fact that low costs are also comprehensible. The Bank Holding Company Act was enacted in 1969, therefore eliminating any possibility of us completing the purchase of all the banks, which meant that we had no further options. So now they are looking for banks to purchase and own. There are times when bank stocks are available for purchase. He is of the opinion that they will, at some point in the not too distant future, buy stocks in other financial organizations. They have also seen the demise of a wide variety of different kinds of institutions. When you find out that there are more banks than bankers, you'll finally understand what he means. If you give it any thought at all, you'll grasp what he means. There have been a significant number of persons who have handled banks in a very irresponsible manner, but as a direct consequence of their actions, opportunities have been made available to other individuals. Throughout the course of history, a significant number of financial institutions have vanished. Therefore, according to Warren Buffett, one should not seek a single statistic, such as relative PEs, to determine how money should be invested. And you really want to look for things you understand and where you think you can see out for a good many years in a general way as to the cash that can be generated from the business. The fact that the item's name is tied to cash is of little consequence if you are able to purchase it for a price that is sufficiently lower than the cash's value. Warren Buffett and Charlie Munger discuss how the questionnaires may even be addressing the incorrect people with their inquiry. He would contend that Warren Buffett and he have not accurately diagnosed the state of the banking industry. He believes that we failed to account for the overall positive results that would transpire, because we had such a great deal of concern about what non-bankers may do if they were put in charge of banks. Warren Buffett then said that there are a number of banks whose intangible net worth has grown by more than 20 on equity over the last 5 or 6 years, even though they have a lot of goodwill. If money is a commodity, you might think it would be hard for a business to do that. Of course, bankers will say it's not a commodity, but it has a lot of characteristics of a commodity. In a world where long-term interest rates are as low as 6% or lower, you could be forgiven for thinking that it would be difficult to maintain those kinds of yields. They were incorrect due to the fact that banks have made significantly more money from actual assets than Charlie and Warren Buffett believed was even remotely possible. Now, he believes that they were able to pull it off in part due to the fact that they made equity go much further than it would have been possible 20 or 30 years ago. He is referring to the fact that they get more money off of each dollar of equity that they have invested than people thought was reasonable 30 or 40 years ago. Nevertheless, they have completed the task. They have been accepted into several banks. In recent years, they have generated extremely high returns on equity investment. And even if you are successful in earning high enough returns on equity and you are able to maintain utilizing more of that equity at the same rate, it is difficult to accomplish both of these things simultaneously. You are aware that the world is changing extremely quickly. You are aware of a lot more than what Warren Buffett might think about how much money more glamorous enterprises have made in recent years. After giving it some more thinking, Charlie Munger came to the conclusion that they had made an incorrect diagnosis. And to make matters even more worrying, it ended up being far worse than that. They are not going to change it no matter what. What are your reactions and views on what Charlie Munger and Warren Buffett had to say in this video? We are looking forward to reading your comments.